the previous lecture, we understood the concept of financial accounting, its need and necessity, various end users of accounting information and the key terms associated with financial accounting. Today, let us first understand the limitations of financial accounting function, and then we will have an insight into various accounting concepts and conventions. Limitations of financial accounting. No doubt, accounting function helps the business to a great extent. It not only helps to maintain a proper record of all business transactions, but also enables future decision making by providing important and relevant information. But on the other hand, there are a number of limitations of this function of business. Let me briefly describe this. Incomplete business records. The first and foremost limitation of accounting function is that it reflects incomplete business records. As discussed earlier, accounting process considers only those transactions of business which can be expressed in terms of money. It avoids those transactions which are purely qualitative in nature and cannot be quantified. For example, quality of goods produced is very important factor for success of any business, but it has no place in books of accounts. Similarly, factors like performance and potential of manager, quality of HR practices, market standing of a business and similar qualitative business issues are not recorded anywhere in books of accounts. Accounting is a post-mortem exercise. Accounting function is considered as a post-mortem exercise as it records only those transactions of business which have already taken place. The businessman has absolutely no control to improve these transactions as they have already taken place. Anticipated or future transactions have no place in books of accounts. Further, the transactions are recorded on the basis of historic value which may not be fair value. Then, room for biasness. Accounting function is based on various principles and rules. The interpretation of these principles is subjective in nature and is largely dependent on the personal opinion of the accountant. So, there is a space for biasness. To take advantage of this, various businessmen may interpret different rules and principles differently. Possibility of window dressing. Accounting books are the basis of preparing final accounts of business, which in turn are the basis of laying various taxes. So, businessman wants to show losses or lower profits. This motivates the businessman for window dressing in books of accounts. It is a limitation of accounting that it cannot prohibit or check window dressing in books of accounts. Provides inappropriate information. At times, accounting supports presentation of inappropriate information. It may incorporate items at such value that are wrong just because they satisfy the technical requirements of accounting process. Due to this, certain items which are absolutely valueless finds a place in accounting books, whereas certain other items which have good value do not appear in books of accounts. Let us understand it with the help of an example. A firm bought a computer for rupees 50,000 and depreciated it 50% per annum. At the end of second year, the value of computer in the books of firm becomes 0 and it appeared nowhere in accounting records, while in fact the computer was still existing in firm's office with an appropriate market value of rupees 20,000. On the other hand, an asset, say furniture, which practically has no value, may appear in books of accounts at considerable value due to accounting process. Then, no consideration to time value of money. It is also one of the major limitation of accounting that it does not consider time value of money. As accounting records the various transactions on accrual basis, it needs to consider their amount after adjusting them for time value of money, which it does not. For example, let us say a firm purchased goods worth rupees 50,000 on credit from any firm, the amount being payable after a year from now. While preparing the accounting records today, the liability of the firm dues to enterprises or the firm from which goods have been purchased will appear at rupees 50,000. Now, if we consider time value of money, the present value of rupees 50,000 to be paid after 1 year should be less than rupees 50,000 depending upon the normal rate of return in the market. Accounting principles do not consider this. Accounting is a pervasive function and business and other firms performs it irrespective of their size, location and nature of activity. So, there need to be some universally accepted guidelines to guide performance of accounting function all across the world. In course of time, certain fundamental rules have been evolved on the basis of practices of accounting profession, which gives the direction to standardization of accounting function across the globe. These rules denote the fundamental truths and generalized decisions for practicing the accounting function and are known as accounting principles. There are certain other terms that are also widely used along with the term principles. These terms include concepts, conventions and postulates. There are basically two groups of experts regarding use of these terms including principles. One group of author classifies accounting principles as concepts or basic principles and conventions or postulates, and other group considers various terms interchangeably. Again, there is no unanimity of thoughts regarding classification of certain principles as concepts or basic principles or conventions or postulates. For the sake of our study, we will classify accounting principles under two headings, that is concepts and conventions. Now, let us have a look into accounting concepts. Accounting concepts are the basic principles which provide conceptual guidelines for practicing the accounting function in an organization, that is recording, measuring, finalizing, communicating and interpreting the information relating to financial transactions of an organization. These concepts lay down the foundation of accounting function and do not deal with individual accounting issues. Rather, they generalize the various accounting procedures. The importance of accounting concepts has been well recognized by various authors. In the words of Welsh and Glenn, accounting concepts are important because they are help explain the why of accounting, provide guidance when new accounting situations are encountered, significantly reduce the need to memorize accounting procedures when learning about accounting. Now, let us have a brief insight into important accounting concepts. Separate entity concept. According to this concept, business has a separate entity which is altogether different from the entity of owners, managers, creditors or anybody else. Accordingly, the books of accounts are the accounting records of business and not of the owners or managers. Thus, while writing the books of accounts, transactions are considered from the viewpoint of business organization and not from the viewpoint of owners or other parties. Only those transactions are recorded in books of accounts which affect the business firm and not the personal transactions of owners or anybody else. This concept is also known as accounting entity concept and is applicable to all types of business and other organizations. Based on separate entity concept, the contribution made by owner to business, that is capital, is treated as a sort of liability of the business. As a business can borrow money from outsiders, it can borrow money from insider, that is owner as well. Accordingly, capital is an internal liability for business. Going concern concept. As per this concept, business is expected to run for a long period of time, say indefinitely, under normal circumstances. Accordingly, while preparing books of accounts, we assume the life of business to be indefinite. Based on this concept, all the transactions of business are classified as capital transactions and revenue transactions. While capital nature transactions affect the business for longer span of time, revenue nature transactions affect business for a shorter duration, say up to 1 year or accounting period. Money measurement. This concept states that only those transactions are recorded in books of accounts which are measurable in monetary terms. There are various aspects of a business and a number of business transactions takes place, but all the aspects in transactions are not recorded in books of accounts. Based on this concept, we record only those business transactions in books of accounts which can be valued in exact monetary terms, and business transactions that cannot be measured in terms of money are not recorded in books of accounts. Let us have an example on this. If a business produces goods that are far superior in quality as compared to the goods of the competitor firm, this superiorness of quality cannot be recorded in books of accounts, although quantity produced and its value can always be recorded, which may even be same for both the firms. Accounting period concept. As a business is expected to survive for a very long period of time, if we wait for that time period to exhaust, it will be difficult to know about the results of the business activities. So, based on going concern concept, accounting period concept states that for the purpose of accounting, life of business must be divided into smaller time frames of equal period, and each such time frame is known as accounting period. Normally, a 12 months time period is acceptable as accounting period universally, which starts on 1st of April every year and ends on 31st of March of next year. This is also known as financial year under the provisions of tax laws of various countries. Historic cost concept. This concept is also known as cost concept. Here, cost is not to be connoted for expenses. Rather, it is to be understood as the value or amount of money spent or generated either immediately or on deferred basis out of a transaction. According to this concept, business transactions are recorded in books of accounts on the basis of historic cost, that is, value incurred for the transaction. This means that when we record a business transaction in books of accounts, we record it for the amount of money that we spent or generate through the transaction, and no consideration is given to fair market value, anticipated value or expected value. Let us understand it with the help of an example. If an organization purchases machinery for rupees 3 lakh out of bargain, it will record the purchase of asset, that is machinery, in books of accounts for rupees 3 lakhs only, no matter machinery's normal price in the market was rupees 3.75 lakhs. Dual aspect concept. This concept is the basis of double entry system of accounting. According to this concept, every accounting transaction is recorded in books of accounts for two aspects, that is, one debit aspect and one credit aspect. It is to be understood here that two aspects does not means two account. A single aspect may have one or more than one accounts affected by it. So, for every transaction to be recorded, there will always be two minimum or more accounts. Let us understand it with the help of an example. If a business sells good for cash, this single transaction is recorded in books of accounts for its two aspects, one affecting goods and another affecting cash. Next is matching concept. Matching concept states that while writing books of accounts of an accounting period, transactions of same period must be written and matched against each other. This means that for the purpose of knowing the results of business transactions of a particular period, the transactions of same period must be considered, whether the result may be loss or profit. Let us understand it like this. To calculate the profit or loss of any accounting period, the expenses of that period should be matched against the income of that period only. If in first accounting period a business made a loss of rupees 1 lakh and in second accounting period it made a profit of rupees 4 lakh, it cannot transfer the profit of 1 lakh or even more or less of second accounting period to first accounting period, so as to compensate the loss. Full disclosure concept. This concept of accounting states that all the financial information, accounting transactions of a business must be disclosed in books of accounts. This concept is focused towards ethical aspect of business, stating that the accounting information is meant for being communicated to owners and various other stakeholders. The performers of accounting function must ensure that books of accounts discloses all relevant accounting information and nothing must remain undisclosed or hidden, whatever may be the position and profitability of business. Now, accrual concept. This concept of accounting recognizes the time of generation of accounting transaction so that they can be recorded in the books of accounts at right point of time. According to this concept, transactions are to be recorded on accrual basis, that is, as and when accrued, irrespective of the fact that cash is dealt with or not. An extension of this concept is revenue realization concept, which tells us that when we should record or assume the revenue has been realized. Let us understand it with the example. If a business receives a sales order, whether with or without any advance money, it is not recorded as sales transaction until and unless goods are dispatched to the customer. Advance money, if received, is to be recorded as a separate liability till the actual sales tax effect. Similarly, sale of goods for credit is recorded as sales transaction irrespective of the fact that cash is not yet received. Likewise, if a laborer has served for the day or month, his wages have become due and should be recorded in books of accounts whether payment has been made or not. All these transactions are recorded on accrual basis as they have become due, whether cash part was dealt in advance or not yet dealt with. Verifiable objectives concept. This concept underlines the need of supporting documents for recording a transaction in books of accounts. It states that every accounting transaction to be recorded in books of accounts must be based on or supported by a documentary evidence, that is voucher. According to this transaction, no record of an accounting transaction should be made if there is no voucher supporting it. Verifiable objective here means that documentary evidence must be objective in nature, must present the facts of existence of transaction in an unbiased manner, and the document or voucher must be verifiable by scrutiny purpose. Let us take an example on this. A credit sale transaction cannot be recorded in books of accounts until and unless it is supported by a proper invoice bearing the signature of sales executive and passing officer, say sales manager. Accounting conventions are the assumptions that have been generated out from the practice of accounting function over the centuries. Like concepts, accounting conventions have also universal acceptability. These conventions lays down certain traditionally practiced norms and presumptions which are expected to be honored by accountants while practicing accountancy. When compared with accounting concepts, the binding force of accounting conventions is less and organizations at times may deviate from accounting conventions so as to honor the accounting concepts. This means that if there is a clash between accounting concepts and convention, the concept must prevail over the convention. Let us have an insight into important accounting conventions. Convention of materiality. According to this convention, all material information should be recorded in books of accounts with proper details. As an accountant writes the books of accounts, he must take due care to make sure that all important information has been recorded comprehensively. With a casual comparison of convention of materiality with full disclosure concept, a learner may apprehend that the two are in contradiction to each other. but that is not the case. While full disclosure concept requires all the accounting transactions to be disclosed in books of accounts, convention of materiality requires important information to be recorded with proper details. Let us take an example on this. If a business purchases miscellaneous stationery items or say spend petty amounts on amusements like tea, coffee, etc., and the accountant records all such items individually with all details, that would be futile and time consuming exercise. As per the materiality convention, a summarized details of all such expenses would be sufficient, because these are not material items from the angle of organization. But as far as items like sundry debtors or goods are concerned, they must be recorded with proper details, as they are very important for a business. Convention of consistency. Consistency states to stabilization of accounting policies and practices. This convention states that whatever policies and practices have been adopted by accountants in discharge of accounting function must be continued for long and should not be changed frequently for no good reason. This does not mean that accounting policies and practices adopted by an organization are not open to change, but then these policies and practices must not be changed unnecessarily. Let us take an example on this. If a firm charges depreciation on fixed assets on the basis of fixed installment method, first method, it should continue the same method for coming years as well. But after few years, if there is a change in legal provisions and it has become compulsory for a certain industry to charge depreciation only on the basis of reducing balance method, that is second method, assuming the firm to be in that industry, it is bound to change its method of depreciation from fixed installment method to reducing balance method. Convention of conservatism. Convention of conservatism is one of the most important convention of accounting and is also known as Prudence Convention. This concept teaches the accountants to be conservative in their approach and play safe. According to this convention, while performing the accounting function, all prospective losses must be considered and honored, and all prospective profits should not be considered. It means that if a business can foresee some future loss, it should make a proper provision for it now, so as to safeguard itself against the same. In future, if that loss actually occurs, the profitability of business is safe, as it has already made a provision for it. On the other hand, if a business can foresee some future profits, it should not record it until and unless it actually materializes. Hence, the convention focuses on reducing current profitability or say increasing current losses of business with the objective of increasing its future profitability or say decreasing future losses for the better and longer survival. It is on the basis of this convention provision for bad debts is made for expected bad debtors. Let us take one more example on this. Let us say Messrs. Ashok Traders deals exclusively in printers. At the end of the year, it has a stock of 50 printers, each costing rupees 4,500, total stock value rupees 2,25,000. All of a sudden, the company increased the price of printer by rupees 500. Now, if Messrs. Ashok Traders considers this information while writing books of accounts, the value of its closing stock and hence profitability will increase by 25,000 rupees, that is 500 rupees per printer for 50 printer. But according to conservatism convention, this increase in value of stock should not be recorded. Convention of timeliness. This convention states that the transactions should be recorded in books of accounts at appropriate point of time, otherwise their relevance is lost. One of the important objectives of accounting function is to provide relevant and reliable information for various purposes. It will be possible only when this convention is properly taken care of. So, all accounting transactions should be recorded in books of accounts immediately after their generation, as soon as possible. Further, Timeliness reduces chances of frauds, manipulations, misplacements, etc. to a great extent. Convention of industry practice. This convention focuses on specific industry practices. It underlines the existence of specific features of an industry and recognizes that the nature of work and needs and requirements of an industry are different from other industries. Thus, it permits reasonable variation in accounting practices depending upon the nature and requirements of a particular industry. In a way, this convention extends liberty to an organization in a particular industry to adopt different accounting practices in the light of legal and practical requirements. Let us understand it with the help of an example. In normal course of accounting function, a business is required to provide for only actual and anticipated losses, but for organization in banking industry, it is a permissible accounting practice to provide for bad debts losses as a fixed percentage of their loans in the light of banking laws and regulations of Reserve Bank of India. To sum up, accounting concepts and conventions lays down a foundation for practice of accounting function all across the world. These are the basis of universal standardization of this function. Thank you.